Hey everybody, it's Mike from Orderflows and welcome to today's video. Today is Tuesday, January 10th, 2023, and we're 10 days into the new year, and this is our 10th video. We're trying to get them up every day of the week for you guys, even on the weekends. So be sure to subscribe to the channel so you'll be notified when a new video gets posted. And again, if you got any questions, be sure to put them in the comments. Sometimes I'll reply to them, and sometimes I'll try to make a video on them if it needs a little bit longer explanation. And that's what today's video is sort of about, because it was a very interesting question that someone asked, and I was going through some of the comments on some of the recent videos. For some reason I couldn't find that question again, but basically the question was, why am I looking at the footprint diagonally, in the the bid against the offer, and why not just looking at it horizontally, the volume basically that traded on the bid at a price versus the volume traded on the offer at the price. And really it goes back to the markets trade in a two-way auction. So if you're familiar with the dome, right, there's a bid, there's an offer, right? It trades like, for example, it's 39 and a half bid at 39.75 offer, size of 14 by 5, and markets go up or down, but they trade in a two-way auction, right? There's a bid against an offer. Aggressive buyers will buy at the offer. Aggressive sellers will sell into the existing bid and below. This is just my testing and recording PC, so I don't have the depth of market up here, but you're usually going to see, you'll come on my trading PC, I'll have all the volumes filled in because I have the depth of market on that PC. Now, if you're looking at how a market moves, right? Remember, markets are a two-way auction, and we don't really think about it very much, in the sense of, right, we go to a grocery store and you see a fixed price on the shelf for something, right? A loaf of bread is $2.99. Milk is $5, and a dozen eggs now is like $100. But you can't haggle at those prices. Now, when it comes to other things that we buy, cars, houses, there's a offer price, and we come in there, we either pay the offer or we work a bid, in a sense, say, well, you're looking at realtor.com, you see a nice house you like, it's $500,000, but you're like, yeah, I like the house, but you know what, I gotta do this to it, I gotta do some more work, and I gotta put some more money into it. So you know what, even though the house is offered at $500,000, I'm going to bid $450 and see if this guy is going to come down to my price, right? So that's how things in real life trade in a two-way auction. Now, can you look at the volume trade on the bid, the volume traded at the offer at a price like $598 against $477? Yeah, of course you can. I just find it much easier to look at it in terms of the two-way auction, right? When the market was 14 bid at 15, 243 traded on the bid at 14, 477 traded at 15. Now, of course, these bars are going to keep going up and down until they complete. But once the bar completes, then I know that, at this price, when it was 16 bid, only 13 contracts traded. When it was 17 offered, 112 traded. And I know that when it was 17 bid, there was 154 traded, nothing traded on the offer up here at 18. Now, again, there's different types of footprints that you could actually use. If you want to see what the volume is at price, now I know some traders out there, they like to use an actual volume footprint, and they just look at the actual volume that's traded at the price. And let me just change that here for you so you could see. So this is a bid-ask footprint, right? You're looking at it diagonally. You could use the volume footprint, and that will just give you all the volume traded at price. Okay, but this is combined, right? So this is both the volume traded on the bid, the volume traded on the offer. Okay, so you could see here it was 266, 51, 1075, 521, 657, 832. I know people, they like to have a little visual. Sometimes they like to have a profile showing up on the bar and sort of look for these micro volume profiles. You could look at the delta, which is the delta at price at the bar. I did a video on this pretty recently, actually about a week or two ago, on how you could use some of these other types of footprints. But this is the delta here. Let's pull it up here. There are certain things that you can pull away from, certain types of bars. But again, it takes time to find the type of chart that you're going to use, that you're comfortable with, right? That you can utilize the information that you're looking at. I spent a lot of time looking at a delta footprint. I mean, like years, in addition to looking at a bid-ask footprint. And, there's certain things that I like to look for on a delta footprint, right? I mean, a bar like this, right, is very obvious. See this green candle. So this is a delta footprint. So at 13, there was more volume traded on the offer. At 14, more volume traded on the offer. That's why you have just the volume being printed here, 57, which is actually the delta between what traded on the bid at 14 and what traded on the offer. So it's got positive delta of 57. Just as here, you got positive delta of 38, 202, 206, 31, 43, 27, and 11. Now, I'm not going to get into all what you should look for on sort of these different types of charts, but really it's about finding the type of footprint that is comfortable with you, that you can understand exactly what you're looking at in the footprint. So just sort of to get back to the volume footprint, right? The volume that's traded on the bid versus the volume traded on the offer. How I would use it, right, if I was just looking at that information, is I'd be looking for the bars that have very little volume at the top or at the bottom, depending on if it's an up bar or a down bar. So for example, okay, this market is selling off nicely. This red line is the low of the day. We're making new low, new low, new low, got a divergence, bounce up, and we're just sort of hanging around here, right? This 16 level, 128.16. First time you trade it at 16, volume, total volume, 825. What was traded on the bid, what was traded on the offer. Second time, came up. This is a 5-minute chart. So 10 minutes later, you came up, traded one contract. 5 minutes later, the next bar finishes, you trade two contracts. Now this is bonds. This is a 5-minute chart. And when I see, very small volumes like 1 or 2, it's telling me something. It's telling me, traders aren't interested in taking it higher. Now, I would sort of use the same information if I was looking at a bid-ask footprint. But when I start seeing, very small volumes on tops of bars and the bars closed on their low, well, it's telling me, at the upper end, there was nobody interested in taking it higher anymore, right? First time you came up here, there was nice volume. Now it's struggling, and the market continues down. Just as if, well, let me go back here, right? Again, market is just powering down. I've got a 6, right, on this green candle. I've got a 5 down here, okay? Which candle would I be more interested to buy? Well, I would never be interested to take a trade right before 7:30. But after this low is made here at 7:40, I got this nice green candle. I got 5 down here. Okay, we close up on the high. As opposed to this bar, we close sort of back in the middle. Right? I'm always looking at the relationship of where price is trading relative to where the bar is closing, especially if you're on a time-based chart or a range-based chart or any type of chart. Right? You want to know, are we closing on our extreme? Because chances are, if you're going to close on your extreme, chances are you're going to continue in that direction. Now, of course, as I said that, this next bar came back down. But as it came back down, what do I see in terms of just raw volume? Well, I know the first time we came down, there was heavy volume, right? It traded 59, but then it ran into 1,000 in this next bar, got through it, ran into another 800. Now, as it starts coming back up, I could see here at 22, there was 787 traded total at this price, both the bid and the offer. I know it gets a little confusing because you're looking at the total volume for what was traded on the bid and the offer, and it just puts it on one side. I mean, it has to just put it on one side of the chart because it's just total volume. You can't put it in the middle of the bar. One, it's going to be hard to read, and two, it's, from a programming standpoint, it's just not possible. And then you get another heavy volume here. So I know that generally, if I'm looking at bars that have heavy volume towards the bottom, I know there was some sort of support. Okay, and people say, well, how do you know, right? Because it's just telling you that volume. It just shows you 787. It could have been you know, 2 contracts on the bid and 785 traded on the offer. You know, people say, well, isn't that indicative of strong selling? Well, at the same time, it's indicative of strong aggressive buying. If it was actually 2 on the bid and 785 on the offer, I know that somebody came in and scooped that all up, right? They just ate it. And then market went higher, just as if this was 5 that traded on the bid and 870 traded on the offer, this total of 875. I know that, yeah, sellers were coming down, offering out supply, but somebody just came in and bought it all. And now we're trading higher, just as, you know, when we get up here, sort of, you know, hit this, I guess you'd call this a swing high, start coming off, and you see some decent volumes in here, 897, 952. Okay, I don't know. You know, I can't really gauge one way or the other if it's going to be supportive buying or resistance selling that's coming in here, because again, I'm just looking at the raw volume. So I'm going to be watching what happens with price. Is price reacting to these levels or not? But when I start seeing, you know, things like this, 4 contracts, right? The market sort of dipped below a level and you trade 4. Well, that's telling me the market was sort of testing down here. Can we go lower? Nope. 4 contracts trade. Market closes back up. You know, I'm always looking for these areas where, you know, I'm seeing just light volume. And again, you know, people are always looking at things like the dome and the heat map for areas of big resting liquidity, right? That's the whole selling point of things like a dome or a heat map or a book map, is you can see the resting liquidity. And yeah, that is great. That there's good trade opportunities by knowing where the resting liquidity is. But at the same time, there's also great opportunities by looking at a footprint and seeing where there was, I don't want to say lack of liquidity, but like little trading going through, right? You can see here, right? We hit the high, sell off, come down here, make a new low, total of 6 contracts trade. Okay. Normally you're getting anywhere from, you know, several hundred to over 1,000. Now, this is a bond 5-minute chart. Let's take a look at, you know, a much thicker, more liquid market, right? The 5 years. 5 years, you know, some price levels, you could be trading tens of thousands of contracts. And this is where looking at things like lack of volume is really going to help you. 1 contract trades, you know, 2 contracts trade. You know, you're seeing these volumes in here, 3,000, 3,000, 2,000, 7,000, 4,000, right? And you get 19, you get 2, right? So you're always looking for these areas where there's just small volumes going through, right? You came down in here, look at this, right down into these lows. Okay, you trade 3, comes up about a tick or 2, comes down, makes new lows, right? Trades 231, then it trades 33 contracts. So you have a divergence here. Now, there's actually a bullish ratio. I have the ratios turned off here. I want to get to that later this week, talking about ratios. But 4,600, 4,300, 1,500, 2,700, and at this low on this bar, you trade just 33. Where is your selling? It's just not there, right? So while looking at resting liquidity is good and it's useful, right? Don't get me wrong. I also like to look for areas of volume, right? Areas where, you know, because volume is something that can stop a move, right? Imagine it's like putting up a wall, right? And you're driving a car, there's a wall there, a car's going to hit it and generally stop when it runs into heavy volume. The market's the same way. But what people often fail to also realize is when there's nobody else trading at that level and the market starts reacting from it, it often gives you a good trading opportunity. So again, I hope you guys found this video useful. And if you did, be sure to subscribe to the channel so when we post a new video, you'll get, hopefully you get a notification. So thanks everyone, and I'll see you guys on the next video. Bye-bye.